Good morning, students. Happy Diwali to all of you. Welcome back to Commerce Veda channel. There is a gap because of work and back-to-back festivals. And today, on the request of one or two students whom I know, I am recording a rapid session on capital budgeting. Capital budgeting. See, there are two types of capitals if a company wants to run. Number one is working capital, and number two is long-term capital, or we can call it as fixed capital. So working capital is for operations and long-term capital is for total. This is for business in long run. Working capital represents current assets minus current liabilities, whereas business in long term represents investment in fixed assets, property, plant, equipment, and machine, all a special factory or a special machines, etc. It includes in PP anyways. So long-term capital decisions are called as capital budgeting decisions. And short-term capital is called as working capital management. So both the capitals are important to run any business. Long-term capital gets more importance. The reason here is this involves huge capital outflow. Huge capital outflow because you want to invest in a machinery, you want to invest in a project, you want to take up a new project. So you need to invest a lot. It involves huge capital outflow, and these decisions are irreversible. Once you invested, it is not at all or highly impossible to cancel those decisions because that involves a lot of capital invested. And moreover, these are based on future projections. So these decisions are very, very important. As this is a quick and rapid session on capital budgeting, I'm not going in detail about the theoretical topics. I'll be going in detail about the practical aspects of capital budgeting. But however, capital budgeting decisions are very, very important because they involve huge capital outflow and decisions are irreversible, and these are based on future projections. You need to predict the future, especially where future is always uncertain. Hence, your decisions should be more accurate, near to certainty. That is where capital budgeting decisions plays a very, very important and vital role in any organization. Now, when it comes to the chapter what we are doing, it is called capital budgeting tools and techniques. Capital budgeting tools and techniques. What are the various techniques we use in this chapter to identify a project? Basically, why capital budgeting to be done? It is basically number one, selection of a project, or selection among alternatives. It means accept the project or reject the project. Only single project, it is accept or reject. Various project, accept one, reject the other. Right, this is selection among alternatives and selection of a single project. On what basis? Or number three, also a replacement decisions. It is like replacing the existing machine with a new machine. Can I replace or not? So these are all the various places where we use capital budgeting techniques. Like, shall I reject or accept a project, or shall I reject or accept projects among the alternatives, which is the best, choose the best, and also accept or reject. Now, when I talk about alternatives, there are two types. Number one, mutually exclusive projects, and number two, mutually not exclusive projects. What does it mean? Here, mutually exclusive projects means if there are 3 projects, one selected, automatically other 2 are rejected. It means you can only select one among the 3. Other 2 are automatically excluded from the selection. That is called mutually exclusive project. Suppose say A, B, C. These are the selection criteria. 3 projects. If you say A selected, it means B and C can't be selected, because these are mutually exclusive projects. Means only one among the alternatives you can select. All others are automatically rejected. When it comes to not mutually exclusive, you can select all which are profitable, subject to funds availability. So if you have funds for taking up all the projects and all the projects are profitable, you can select all the projects. Or you can select any of them of your choice, subject to the funds and subject to the profitability. So there is nothing like if I select A, B and C are not to be selected. That is not there. That is not there in mutually not exclusive, but is there in mutually exclusive. That is the basic understanding about the techniques why we use. We use the techniques for accept or reject decisions, selection among various alternatives, and a replacement decisions. And last decision is called as capital rationing decision. What does it mean? Example, say I have 50 crores of money with me, and I have 4 projects A, B, C, D. A project requires 10 crores, B requires 20 crores, C requires 20 crores, and D requires 10 crores. So total investment required is 60 crores, but I have only 50 crores money. So now I need to see which projects that I can select, which are all the projects I can select. Assume A is having a negative results and B, C, D are giving positive results. So I can select B, C, D. I need to distribute my money among all the other projects. That is called rationing. Suppose A, B, C, D all are having positive results. Then I need to see which is best among all the 4 and allocate the funds. Allocate funds to the best and next best till my funds are utilized. That is called capital rationing. I need to allocate my funds wherein I can take up all the projects if I have enough funds, but if I have minimum funds, I need to select among the projects which project first and which project is last. With this decision we'll see in the next our next session. Now coming to the techniques. Techniques are of two types. Capital budgeting techniques. One is non-time value based. Other one is time value based techniques. Non-time value based techniques and time value based techniques. What does it mean by time value? Here, no importance given to time value of money. We know what is time value of money. The rupee received today is more valuable than the rupee received after 1 year, because the rupee received today you can invest and make it more, right? So time value based techniques is giving importance to time value of money. Time value of money. Here, non-time value based techniques, most popular technique is called payback period, and the next technique is called payback reciprocal, and the next technique is called payback profitability, and the next technique is called accounting rate of return. There are 4 non-time value based techniques. Also, we also call them as historical or old techniques, which are not taking time value of money into consideration. Whereas time value based techniques are called discounted payback period, net present value, popularly called as NPV, profitability index, popularly called as PI, internal rate of return, popularly called as IRR, modified internal rate of return, popularly called as MIRR, adjusted NPV method. So there are so many methods in non-time value based and so many methods are time value based. However, if I look at the examination perspective, most of the times you'll get sums from payback, discounted payback, NPV and IRR. Others are, I'm not saying others are not important, but these 4 are the techniques mostly come into the examinations. Discounted payback, NPV, IRR from time value based. We also can call them as modern techniques. Modern techniques, and these are traditional techniques. Time value based, non-time value based. So the focus of today's session is quickly understanding each and everything so that we need not worry about the presentation in the examination. So in brief, what exactly we discussed is capital budgeting is one of the important topics of a finance manager, and it is for planning for long-term capital investments like business in long run, like investment in PPE, special factories and special machines. It is whether to invest in a project or not. Whereas working capital is about operations, which is current assets and current liabilities, which we will discuss in an additional session on exclusively on working capital. Now, and capital budgeting decisions, why they are very, very important? Because they involve huge capital outflow. Say suppose you want to construct a factory or purchase a machinery costing 3 crores. It is huge money. You should take a decision today before investing, so that whether I can invest or not, you can save it if it is not a good investment. And decisions are irreversible. Once you invest, it is very difficult to take back. You have to do the business or make the loss completely. And these are based on future projections, and future is always and always uncertain. So you need to take decisions under uncertainty. That is very, very important management function. Management should know all the uncertainties and plan its cash flows based on the uncertainties before taking the decisions. When it comes to capital budgeting techniques, why these techniques? These techniques are to accept or reject a project. If it is a single project, whether to accept or reject. We use the technique and we'll say whether it is good project or not. And second one, if there are alternatives, you should select among alternatives which one is to be selected and which one is to be rejected. Then replacement decisions, whether I should replace my existing PPE or not. And also we call it as, when it comes to selection, there are two types of projects: mutually exclusive, mutually not exclusive. In this case, if you select one, others are automatically excluded. That is called mutually exclusive. Whereas mutually not exclusive means you can select all depending upon the profitability and the availability of funds. And then capital rationing. How do you distribute the limited investment in taking up most profitable projects is called capital rationing. And techniques, when we discuss, there are two types of techniques: non-time value based, or we call them as traditional techniques; time value based, or we call them as modern techniques. And in non-time value, we have payback period, payback reciprocal, payback profitability, and accounting rate of return, popularly called as ARR. And modern techniques, time value based techniques, we have 5 techniques: discounted payback, net present value, profitability index, internal rate of return, modified internal rate of return, and adjusted NPV. Now I'm going to cover all these topics one on one with two examples. As a rapid revision session, we will carry on this session, and this session shall help people who start preparing their capital budgeting just before the examinations. Especially I'm focusing more on ICAA Inter exams coming in December. Right? Let us start with the first technique, which is called payback period. It is called as non-time value based technique, or we can say traditional technique. This is generally used in lesser period, not a longer period investments. Shorter period investments we use payback period. It says, what does it mean? It means select the project which pays you back the investment made initially. Which pays you back the investment made initially in a shorter time. Example, see, select the project which pays you back the investment made initially in a shorter time. A small example, I have project A and I have project B. Very small example. I invested investment 50,000 in project A and 40,000 in project B. I invested. Now, annual inflow, project A is giving 20,000 per annum and project B is giving 15,000 per annum. Right. So what shall I do here is how much fast I am recovering my investment. So in this case, my payback period is investment by annual inflow. In this case, it is 50,000 by 20,000. I'll get 2.5 years. 2.5 years. So 2.5 years, I am getting my investment back. And here it is 40,000 by 15,000. I'm getting back in 2.67 years. It means project A is giving me back funds quickly. My total investment I'm able to collect in lesser time than project B. It is a general understanding. We'll go and in detail about the formula. But what is payback period? It says how quickly you are recovering your investment back from the project. In these two projects, you are recovering in 2.5 years your investment, you are recovering in 2.67 years your investment. So I go with A, which is shorter payback. Alright, that is the concept. Now, understanding the formula, this formula has two parts. In not two parts, two types I can say. Number one, annually even net cash inflows and annually uneven net cash inflows. What does it mean? Even net cash inflows and uneven net cash inflows. Even net cash inflows means each year same net cash inflow. Hypothetical. It means every year you are receiving the same net inflow, like 10,000 per annum, 20,000 per annum, 30,000 per annum, but the inflow is not changing. Same inflow. Here, uneven. So your inflows are changing, and which is mostly, this is mostly practicable. Mostly practicable here, not practicable. Now, what is the formula here? The formula here is payback period equals to initial outflow divided by annual net cash inflow. Here this is different. Here payback period equals to base year plus initial outflow minus cumulative net cash inflow of base year divided by net cash inflow of subsequent year. So what is this that we should understand? What is this that we should understand? It is payback period equals to base year plus initial outflow minus cumulative cash inflow of base year by net cash inflow of the subsequent year. And here it is simple. Net initial outflow divided by annual net cash inflow. Now, before going to understand this formula, We also need to understand what is called net cash inflow. Right? How do we do this? Net cash inflow. It is nothing but EBIT minus interest. Or I can say even more detail. EBITDA, interest, earnings before interest, depreciation, taxes and amortization, minus depreciation and amortization, you will get EBIT minus interest, you will get EBT minus tax, you will get earnings after tax plus depreciation and amortization. So you will get net cash inflow. Why we are adding it back? Because it is a non-cash item. See, it is deducted for tax purpose, but adding it back because it is not a cash outflow, it is cash in the company. So out of your profit of 100, suppose your depreciation is 20, your EBIT is 80, assume your interest is also 20, so your earnings before tax is 60. You're not paying tax on 80, you're paying tax only on 60. Assume tax is 1/3, that is 20. So your EAT is 40. And adding back your depreciation 20, your net cash inflow is 60. Why? Because 40 and the amount saved from tax, but it is not an expenditure. It is an accounting expenditure, but not a cash expenditure. So 40 is your net cash inflow. So here the net cash inflow is nothing but this. So these are the basic concepts we should understand. What is EBIT, which is earnings before interest and tax? What is EBITDA? Earnings before interest, depreciation, tax and amortization. And what is EBT? Earnings before tax. What is EAT? Earnings after tax. What is net cash inflow? Is earnings after tax plus depreciation and amortization. So now let us understand simply first method, payback period, even cash flows. Payback period and even cash flows. Even means constant cash flow. I'm giving you project A, project B and project C. Now outflow 1,75,000, 80,000. Now I'm also giving you annual cash inflow. I'm giving this annual cash inflow net 25,000, 25,000, 25,000, all the cases. Now I should compute my payback period, nothing but if it is 1, if it is 2, it is 1/2. Initial outflow divided by annual cash inflow. Here it is 4 years. Here it is 3 years. Here it is 3.2 years. 0.2 year means 12 into 0.2, 2.4 months. So 3.2 years. Now I select which one? This one. Why? My investment is coming early. I am getting back my investment in 3 years. That is called payback. I select the one with shorter payback period. Shorter payback period. Because future is uncertain, select those projects which gives you your investment back. Right. Now, however, the catch here is payback period shall be lesser than the useful life of the project. So project life, suppose 5 years, payback should be less than project life. If the payback is beyond project life, automatically reject. You should get it before the life of the project. Then only you can make profit. So this is a simple example. Now one example, what we can do, we will be doing it from the textbook. Any small question we'll do from the textbook. Whereas simple sum I'll again do. Second example. Example 2. Project A and project B. Initial investment, say 2 lakhs and 3 lakhs. EBIT is given 50,000, 70,000. Interest 10,000, 15,000. EBIT I said means after depreciation. So depreciation 10,000, 15,000. Tax rate 25%. Life 5 years, 7 years. This is the data. Now this is EBIT per annum. So this is a classic example of even cash flow. Now we'll see what is inflow, net cash inflow for both, for A and for B. Solution. EBIT 50 and 70 less interest 10,000 and 15,000. We get EBT 40 and 55, and we have tax at 25% of tax is 10,000 here, and 25% of 55,000 is 13,750. So your earnings after tax 30,000 and 41,250, and your depreciation 10 and 15. So your net cash flow, net cash inflow is 40,000 and 56,250. 40,000 and 56,250. So this is your first note. Then you should compute payback period. How do you compute? Initial investments 2 lakh and 3 lakh. Net cash inflow per annum 40,000, 56,250, and payback period, it is A, it is B, then C equals to A by B, it is 5 years and it is 5.33 years. 5.33 years. Prima facie, using payback, we select this because shorter payback. We'll see later what is the use of useful life. Here useful life is 5, collected in 5 years. So in fact there is no profit in this project, but prima facie, taking the payback period as the technique, we will select this project A because of shorter payback period. This is the basic understanding of uneven cash flows and payback period. So we selected project A because of shorter payback. What is the decision of payback period? Select the project with shorter payback. Now, one more sum we'll take wherein we'll understand both even and uneven. The sum says like this. This is example number 3. The sum says like this. There are 2 mutually exclusive projects. What does it mean, mutually exclusive? Only one project you can pick, either A or B. You can't pick both. Now, these projects, life of both 5 years. So life is also given. Both projects life is also given. And initial investment 10,000. So initial investment is also given 10,000. Right. And then because initial investment is 10,000, second thing, tax 50%. Tax is given 50%. So tax is also given, and depreciation at straight line method. So these projects are depreciated at straight line method. Cash flows given below. The cash flows were given below. So I can take the cash flows as year 1, 2, 3, 4, 5. They are 5 years. And say project 1, it gives a cash flow of 4,000, 4,000, 4,000, 4,000 and 4,000. And project 2 is giving a cash flow of 6,000, 3,000, 3,000, 5,000 and 5,000. So we observe that this is giving a even and this is giving a uneven cash flow. So both the cases, this is even and uneven. This project is giving full, and these are all net cash flows. It means depreciation and other things are adjusted cash flows. So again, you need not do taxation and all. These are all net cash flows. Net cash flow means after depreciation, after tax. So now project 1 is what it is having? Even cash flow every year 4,000. So for project 1, my payback period equals to initial outflow by net annual cash flow. cash inflow. That is 10,000 by 4,000. Every year same. So it is 2.5 years. Very simple. As it is even every year the same cash inflow. So even inflow. So what it is? Initial outflow by net annual cash inflow. I got 2.5. Whereas project 2 is uneven inflow. It is changing. So I cannot use this formula. I can't use the formula because the inflow is not common every year. It is not even. Then I should go to second formula. For that I need a small table. The table is here. Net cash inflow. Cumulative net cash inflow. This is called cumulative net cash inflow. What it is? 1, 2, 3, 4 and 5. First year inflow is 6,000. Cumulative also 6,000. Second year inflow is 3,000. Cumulative is 9,000. Third year inflow is 3,000. Cumulative is 12. How it is? It is 6 plus 3. This is 9 plus 3. And then fourth year inflow is 5,000. This is, I can say 12 plus 5. And fifth year inflow is also 5,000. It is 22,000. So it is 17 plus 5. This is 6 only. So same here. So I identified my net cash inflow and cumulative net cash inflow, and I should see where is my investment is getting back. What is my investment? 10,000, right? So coming back, my investment is back between third and second and third year. See, third year it is more than 10,000 and second it is less than 9,000. So my investment is back between second and third year. It is in between second year and third year. Neither second year nor the third year, in between. So this second year is called as base year and this third year is called as subsequent year. So 2 plus 3 minus. It is 2 years plus, but not even 3 years. It is in between second year and third year. So I will say base year is 2 and subsequent year is 3. Now I use my formula. Payback period equals to base year plus initial outflow minus cumulative net cash inflow of base year divided by cash inflow, net cash inflow of subsequent year. How it is? Base year is 2 plus 10,000 minus 9,000. This is cumulative. This is base year. Where initial investment is here. So by subsequent year investment is how much? 3,000. Cash inflow, not cumulative. Net cash inflow. Net cash inflow. So base year, cumulative and net cash inflow. That is 3,000. So it is 2 plus 1,000 by 3,000, that is 2.33 years. 2.33 years. So 2 years and 0.33 years from nothing but 2 years. 0.33 of 12 is 4 months. 2 years, 4 months. how it is 0.33 year? 0.33 year means 12 months in a year into 0.3333 is 4 months. So 2 year 4 months. First case 2.5 years means 2 year 6 months, because 0.5 of 12 into 0.5, 12 months into 0.5 is 6 months. So project 1, now decision here is project 1 PBP 2 years 6 months. Project 2 payback period is 2 year 4 months. So this is having shorter payback period, and hence I select project 2. Uneven. When it is uneven, I need to go with a small table year, net cash inflow, cumulative net cash inflow. So the base year is the year subsequent to the year in which you have cumulative cash flow is less than the investment, but the subsequent year it is more than the investment. It is falling in these two, between these two. So 2 is base, 3 is subsequent. The answer should be in between 2 and 3. 2 year 4 months, 2 year 5 months, 2 year 6 months, whatever it is. But the answer must be in between 2 and 3. So this is how you should do when it is uneven cash flow. This is the decision making tool. Right. Now, if the same sum, I consider as it is cash, not net cash inflow, it is only cash inflow, then we need to do a lot of adjustments. How it is? So, same sum, example 4. I will take the same sum, which is year 1, 2, 3, 4 and 5. Right. Cash inflow. I said only cash inflow. Just inflow, not net cash inflow, which is 4,000, 4,000, 4,000, 4,000 and 4,000 is the inflow of project 1. Inflow of project 2 cash inflow as 3, 6,000, 3,000, 3,000, 5,000 and 5,000. Investment 10,000 for both the projects, 10,000 each project. Depreciation SLM, tax rate 50%. SLM and tax rate 50%. So this data is given, and these are all cash inflows, not net. Now we should identify net cash inflow. How do we identify that? I should do it for both particulars, like calculation of net cash inflow. Very, very important sum. Please watch carefully. This is solution. Net cash inflow, I should prepare like particulars. Better I'll prepare a tabular sheet. First for project 1. Right. Year 1, year 2, year 3, year 4, year 5 and particulars. I'll write annual cash inflow 4,000 each year, but this is not net. In the previous question we taken 4,000 as net cash inflow, but now it is not net. Now annual cash inflow. Basically, annual cash inflow before interest and depreciation. After, then what we should do here is, this is, when I say annual cash inflow, I'll write one more line here. Cash inflows are as per P&L before tax. So before tax, these inflows are as per P&L before tax. It means already depreciation is deducted. There is no interest given in the question. So now I should do less tax. So interest is no more in the question and depreciation is deducted, right? Or we can assume, we can write before tax and depreciation for easy convenience. So before tax and depreciation, let us say take it before tax and depreciation, as if depreciation is not deducted. These are the inflows as per P&L before tax and depreciation. Now I should first deduct what? Less depreciation. In this case, what is depreciation? Project 1, project 2. Depreciation is what? Investment minus scrap value by life. Same, investment minus scrap value by life. Your life is 5 years. Scrap value is 0. So each year depreciation is 2000. 10,000 by 5 years. Right. So if we want to do it in a detailed way, depreciation, I'll be doing in a working note here. Computation of depreciation. Project 1, a project 2. Amount invested in the project 10,000. Scrap value 0, 0. There is no salvage value. So depreciable amount 10,000, 10,000. Life 5 years, 5 years. So depreciation per annum 2000 and 2000. So generally the formula is original cost less scrap divided by life. No scrap is given. So original cost minus 0 by 5, 2000. Now coming back, depreciation is 2000. I keep it in negative. So I'll get earnings before tax. Before tax. Earnings before, because there is no interest in this question. So before tax is 2000. So tax at 50% is the tax rate is given. So 1000, 1000, 1000, 1000 and 1000. So tax rate is given 50%, and then what we should do? Earnings after tax, also called as net cash inflow. Right? Here it is 1000. Net cash inflow kaadu. Earnings after tax, that's it. It is not net cash inflow. It is earnings after tax. add back depreciation 2000, so you get net cash inflow 3 3 3 3 and 3, and this is again even project 1 is even cash inflow. So payback period of project 1 you can simply compute initial outflow by net cash inflow per annum 10,000 by 3,000, 3.33 years. 3.33 years for project 1. Now for project 2, similarly we should do year 1, 2, 3, 4 and 5 earnings before depreciation 6. This is the project 2, 3, 3, 5 and 5 less depreciation already computed 2, 2, 2, 2 and 2. 2, 2, 2, 2 and 2, and this is earnings before tax 4,000, 1,000, 1,000, 2,000, sorry 3,000 and 3,000 less tax at 50%, 2,000, 500, 500, 1,500 and 1,500. So your earnings after tax are 2, 5, 5, 15 and 15. Now you add back depreciation 2, 2, 2, 2 and 2. You'll get net cash flow. Net cash inflow is 4, 2, 5, 2, 5, 3, 5 and 3, 5. Right. So this is the net cash inflow and it is uneven. Hence we use the other formula which is particulars cash inflow, net cash inflow 1, 2, 3, 4, 5, 4, net cash inflow, cumulative net cash inflow 4, 2, 5, 6, 5, 2, 5, 9, 3, 5, 12, 5, 3, 5, 16. This is nothing but 4,000 plus 2, 5, 6,500 plus 2, 5, 9,000 plus 3, 5, 12,500 plus 3, 5. So now you see your investment is 10,000, which is between third and fourth year. Third and fourth year. So third year being the base year and fourth year being the subsequent year. Third year being the base year, fourth year being the subsequent year. Now base year 3 plus initial investment minus cumulative net cash inflow up to the base year by net cash inflow of subsequent year. So it is 3 plus 1000. So it is 3 plus 1000 by 3500. 3.285 years, 3.29 years. Yes. So P1 3.33 years, P2 3.29 years. I select P2 being shorter payback. Shorter payback. In the first option, I selected which one? In the first option, I selected 2. Why? Because it is 2 years 4 months. Here also I selected project 2 because 2 year 3 year 2.3.29. 3.33 is equal to 3 years 4 months. 3.29 equals to 12 into 0.29, 3 years 3 months 3 year 3 months 30 days. 30 into 3 year 3 months, 0.29 into 12, 3.48, 0.48 into 30 is 14 days. 3 year 3 months, 15 or 14 days. So we go with project 2. So the problem here is identify whether it is even or uneven. Even, simple, outflow by annual net cash inflow. Uneven, it is apply the formula base year plus initial outflow minus cumulative cash inflow of the base year divided by net cash inflow of the subsequent year, and identify which is having shorter payback, and that is your payback period, which is that is the decision. You select the project based on shorter payback period. This is all about payback period, even, uneven, using non-time value method. Now we'll understand what is called payback reciprocal. So the simple thing is we need to identify, number one, whether it is even net cash inflows, or number two, whether it is uneven net cash inflows. Even, the formula is initial outflow by net cash inflow per annum. Uneven, the formula is base year plus initial outflow minus cumulative net cash inflow of base year by net cash inflow of subsequent year. So, and the decision, what we decided, decision is accept the project with shorter payback period. This is how we should understand the payback period, non-time value money based practical problems for the solutions. Now, same thing, a simple thing here is in this question, what we did, payback P1, P2. P1 I said 3.33 years and P2 3.29 years, right? Now, very simple to understand what is payback reciprocal. So payback reciprocal is dependent on payback period. You have to compute payback period to compute payback reciprocal. It says payback reciprocal equals to 1 divided by payback period into 100. So in this case, project 1 by 3.33 into 100, which is nothing but 30%, and P2 it is 1 by 3.29 into 100, %30.4%. The first case 1 by 3.33 you are getting 30%, and the second case 30.44%. So the decision in payback reciprocal is choose the project with higher payback reciprocal. It means higher return. Shorter period, higher return. Both gives you the same answer. Both gives you the same answer. But to compute payback reciprocal, you should compute payback period. So they both go hand in hand. There is nothing great in learning payback reciprocal. Suppose say one more example we'll write. There are projects A, B, C, D and E. Payback period is given and we should compute payback reciprocal. Payback period, say it is 3, 4, 5, 2.4 and 2.5. Based on payback, I'll go with D, shorter payback. Now, how do you compute payback reciprocal? Nothing but 1 by payback period into 100, right? So 1 by 3, I'll say 1 by 3 into 100, 33.33%. 1 by 4 into 100, 25%. 1 by 5 into 100, 20%. 1 by 2.4 into 100, 41.67%. And 1 by 2.5 into 100, 40%. So if we go ahead with payback reciprocal, you also selected the same, which is project D. So payback reciprocal is nothing but the same payback. Here you express in number of years. Here you expect in the percentage of recovery. So lesser the number of years, higher the recovery, and higher the number of years, lesser the recovery. The decision based on payback period and payback reciprocal always the same. You are showing in number of years in payback period. You are showing as a recovery percentage in the payback reciprocal. So the lesser the payback period, the higher the recovery percentage. The higher the payback period, the lesser the recovery percentage. This is all about payback reciprocal, not a big sum to learn. It's just a advanced version of PBP showing in percentage terms. So this is all about payback reciprocal. So the next important technique in non-time value method is a very important technique called payback profitability. This payback profitability is actually identified because of the disadvantages of payback period. I will first explain what is the disadvantages of payback period. Number one, or important disadvantage is payback period ignores the cash flows after the payback period. Payback period ignores the cash flows after the payback period. How it works? Let us learn before we conclude on the payback profitability formula. Now take a project again. I will give example number 6 or 7. take project X and project Y. Project X and project Y. Now, here outflow 1 lakh and 1 lakh. 1 lakh and 1 lakh. Now, here inflows, I'm talking about net cash inflows. Net cash inflows 1, 2, 3, 4, 5 and 6. Here it is 20, 20, 20, 3, 4, 40, 5, 20, 6, 10. So 1, 2, 3, 4, 5, 6. And here it is 10, 10, 20, 20, 70 and 80. So year 1, year 2, year 3, year 4, year 5, year 6. So same investment 1 lakh. Inflows in the first 6 years, or life is 6 years, total life is 6 years. The inflows are 20, 20, 20, 40, 20, 10, 10, 10, 20, 20, 70, 80. This is the sequence of inflows we have calculated. Now, what we should do here, the total inflow if you take here, it is 70, 80 plus 60, 140. Right. So 20 plus 20 plus 20, 60, 60 plus 60, 120, 130, I think. 70 plus 60, 130. And here it is 150 plus 60, 210. 210. If you look at the question directly, you think project X is more profitable. Agree, because you are getting a profit of 30 here. 130 minus 1 lakh. You are getting a profit of 1 lakh 10,000 here in project Y. So looking at the problem, prima facie, you say this is more profitable. Right. Now, but what payback period says, we'll see. So payback period says project 1, project 2, I'm computing payback period. Payback period. Here, year, cash flow, net cash flow, cumulative net cash flow. Year, net cash flow, cumulative net cash flow. Right. Now, 1, 2, 3, 4, 5 and 6. So year 1, as per our calculation, 20, 20, 20, 40, 20, 10. 20, 20, again 20, 40, again 20, 60. So 20, 20, 20, 40, 20, 10. So 40, 1 lakh and 20, 120, 10, cumulative is 130. So here looking at the sum, 4th year you received everything. So no need to do the formula here. Here payback period is 4 years. The recovery is not falling between 2 years. The recovery is exactly at the end of 4th year. So it is 4 years payback period. Directly computed. Now coming to this question, this project. It says 10, 10, 20, 20. 10, 10, again 10, 20, again here 20, then it is 40, 20, it is 60, and 70 and 80. 70, it is 130, 80, and it is 210. 210. Now your recovery is falling between 4 and 5. 4 and 5. So fourth year being the base year, fifth year being the subsequent year. 4 and 5. It is 1,30,000 at the end of fifth year, but 60 at the end of fourth year. So your recovery is falling between 4 and 5. So if you see the answer here, 4 plus 1 lakh minus 60 divided by 70. Initial outflow minus cumulative inflow up to the base year divided by net cash inflow of subsequent year. So it is 4 plus 40 by 70. It is 4.57 years. So payback says early is project 1. So select project 1, reject project B. Project 1 you select, project 2 you reject. Payback says. But the payback profitability says after payback, what is your profits? Your profits after payback, or we can say cash flow after payback, both the same because after recovery everything is profit. So here after payback your profit is 20,000 year 5 plus 10,000 year 6, 30,000 after payback. So here after payback it is 4.57, right? So 5.57 means 12 months 0.57. So we can say 1,30,000. We can say year 5. Year 5. 0.57 is payback. So balance is 0.43. So 70,000 into 0.43 and 80,000 into 1 full year. So 70,000 into 0.43, 30,100 and 80,000. So after payback your recovery is 1,10,100. So after payback you are getting more money and less money here. So payback profitability says what is your total profit on the project. So based on total profit you take a selection. So based on payback profitability, P1 total profit is 30,000 and P2 total profit is 1,10,000. Yes, 1,10,000. Hence you select P2. So payback fails in it. Payback stops the cash flows up to payback. It won't consider the inflows after payback. Whereas payback profitability says what is the overall inflow minus outflow. So sometimes the decision based on payback profitability might be better than decision based on payback period. However, since these are short-term projects, we always prefer payback because early receiving back the investment is keep you in a safe side. So that is where payback is more. So as we computed payback period, payback reciprocal and payback profitability, the next important topic is accounting rate of return. Called as ARR. See, accounting rate of return is a method goes with accounting profit. And according to us, what is accounting profit? Accounting profit is nothing but profit after tax. We also call it as PAT. So we do not consider PAT plus depreciation in ARR. In ARR, profit means profit after tax. So the formula here is ARR equals to average PAT by average investment into 100. Now, what is average PAT? Average PAT equals to summation of profit after tax divided by number of years. Summation of profit after tax divided by number of years given in the question. Similarly, what is average investment is? There are two cases. Number one, no salvage value. In this case, it is original investment by 2 is average investment. Case 2, if salvage value is given, then it is salvage value plus original investment minus salvage value by 2 is called your average investment. Take a small example here. So average PAT is summation of PAT by number of years. Yes, N represents number of years, PAT represents profit after tax. Whereas original investment by 2 if there is no salvage value, and if salvage value is given, it is salvage value plus bracket starts original investment minus salvage value by 2. Now, how it goes? There is project 1 and there is project 2, and this is particulars. Original cost given in the question is 56,125, 56,125. Salvage value 3,000 nil, and inflows oblique PAT year 1, year 2, year 3, year 4, year 5, 3375, 5375, 7375, 9375 and 11375, and here it is 11375, 9375, 7375, 5375 and 3375. See here the average profits remains the same because the flow is actually in a ascending order here, in a descending order here. Now let us compute machine 1, or you can say project 1 ARR. Average PAT by average investment into 100. Now what is average PAT? Which is nothing but 3375 plus 5375 plus 7375 plus 9375 plus 11375 by 5. This is average PAT, and average investment is salvage value plus. What is salvage value here? 3,000 plus 56,125 minus 3,000 by 2 into 100. So it is 3375 plus 5375 plus 7375 plus 9375 plus 11375 is total 36,875 by 5 is 7,375 by 56,125 minus 3,000 by 2 plus 3,000 is 29,562.5 into 100. So it is 24.94%. Machine 1. What we did? We've taken all the profits We totaled it and divided by 5. Number of years. What is average PAT? Average PAT equals to sigma of PAT by N. Average investment is salvage value plus original cost minus salvage value by 2 into 100. So we did this for machine 1. So and then project 2, how do we do? Same thing. Average PAT is 11375 plus 9375 plus 7375 plus 5375 plus 3375 by 5 divided by, as there is no salvage value, 56125 by 2 into 100, this is 7375 by 56125 by 2 is 56125 by 2 is 28062.5 into 100, 26.28%. In these two cases, what we should do, ARR P1, P2, P1 is 24.94, P2 26.28%, hence I go with P2, which is having higher ARR. Higher ARR. These two are mutually exclusive projects. So I selected with the one with higher percentage of ARR. So this is very, very important to understand that whenever we do ARR, we should go with PAT. We should go with PAT. So ultimately, when we finish these 4 important topics, what we learned is, number 1, we learned payback period. Number 2, we learned payback reciprocal. Number 3, we learned payback profitability. And number 4, we learned accounting rate of return. So there are so many problems in your ICAA material on payback, ARR, and non-discounted sums. If you can attempt these sums after hearing this particular explanation, we can clear many problems without much difficulty. And ARR will do one more small question here. I'm again giving you example number 11. Here, say machine 1 and 2. Original cost 75,000 each. Life 3 years. And PAT 1, 2 and 3. 50,000, 70,000, 40,000, 60, 60 and 40. So now how do we compute? And then salvage value here 5,000, here nil. So data is given. How do we do this? Here ARR, summation of the 3, which is 50,000 plus 70,000 plus 40,000 divided by 3. Average PAT is 53,333.33 by average investment is salvage value plus original cost minus salvage value by 2 into 100. So which is 70,000 by 2 plus 5,000, 40,000. So 53,333.33 into divided by 40,000 is 133.33%. Second case, this is machine 1. Machine 2 ARR is 60,000 plus 60,000 plus 40,000 is 160. 160 by 3, same 53,333.33 by average investment, as there is no salvage value, it is 75,000 by 2, 75,000 by 2 into 100, that is 37,500. Here it is 142.22%. Since machine 2 is giving me higher ARR, I go with machine 2. So these are all the sums. Quick explanation on the first 4 methods: payback, payback profitability, payback reciprocal, and accounting rate of return. These are traditional techniques. These techniques never use time value of money as a base. Hence, these are all called non-time value of money techniques. Not much in use than the payback period for smaller projects. This is all about the basics. Now, the advanced sums are about time value money base. Time value of money based sums. Which will be continued in the session. So the time value of money based techniques, the first important technique is discounted payback. Discounted payback period. So what is discounted payback? First of all, we should learn what is discount rate. Very, very important. Before going into discounted payback, I also need to explain to you what is discount rate and how it is calculated. See, number here, suppose say today, that is, assume today is 1st October 25. Today I have 100 rupees, right? If today I have 100 rupees and assume I invest in bank at 10% per annum return. So for the year I'll earn 10 rupees, and on 1st October 26 I'll be having 110 in hand. So today's 100 rupees, if I invest at 10% per annum in the bank, it generates 10 rupees. Hence, after 1 year, I'll be with in hand money of 110 rupees. It means 1st October 26, 110 rupees equals to 1st October 25, 100 rupees. So 110 rupees received after 1 year shall be equal to 100 rupees today because of a interest rate of 10%. Right. Simple example here. Today invest 10,000 at 10%, at 12%, at 15%. 3 investment opportunities I have. So today I invest 10,000 at 10%. First year interest, general interest, simple interest I am calculating. 10% on 10,000, I'll earn 1,000. Here I'll earn 1,200. Here I'll earn 1,500. Hence, At the end of first year, my total cash is 11,000 here, 11,200 here, 11,500 here. It means 11,000 after 1 year at a 10% investment rate is equals to, this is equal to 10,000 today. 11,200 after 1 year, which is invested 10,000, shall be equals to 10,000 today, and this will be equals to 10,000 today. So the money earned after 1 year is not equal to the money in hand today. Today's money is most valuable. See, 11,000 after 1 year equals to 10,000 today. So today 10,000 is 11,000 after 1 year. So that is where we call it as money has a time value. The timing of receipt of money is very important. Today's money, always today's money always today's money is more valuable than future money because of the investment possibilities. So this is what we should understand first about time value of money. How do we calculate? Future value equals to present value into 1 plus interest rate to the power of n. Say present value 1,000, 10,000 at 10% interest rate is 11,000. This is future value. Similarly, today's value 10,000 at 12% interest rate for 1 year will be 11,200 future value, and today's value 10,000 invested at 15% at the end of 1 year will be 11,500 future value. So future value must be discounted to today. How I get it? What is 11,000 after 1 year if discounted at 10%? So what you should do? Present value equals to 1 by 1 plus interest rate to the power of 1 into future value. So my future value is 11,000 into 1 by 1 plus 10% to the power of 1, which is 11,000 by 1.1, I get 10,000. This is present value. Similarly, 11,000 into 1 by 1 plus 12% to the power of n is 11,200. 11,200 by 1.12 is 10,000 present value, and 11,500 into 1 by 1 plus 15% to the power of 1 shall be equals to 10,000 today. So future value should be discounted to identify the current value at the given interest rate. So discounted payback says you need to discount the future values to arrive the current value. How it works, we'll take an example here. I have project illustration. For this new series, I'll take illustration 1 as my discounted payback. I'll give particulars, project 1 and project 2. Year 0. Year 0 means beginning of the year. Beginning. It is, say, 2 lakh is the investment. minus value. So this is outflow. Outflow. Now here 1, 2, 3. 3 years my inflows are 1 lakh, 2 lakhs and 2 lakhs. Here it is 1 lakh 50, 1 lakh 50 and 2 lakhs. So I have given a project and the receivables. Absolute money is 5 lakhs and 5 lakhs. But I should identify present value. I'll say the cost of capital 10%. Existing cost of capital is 10%. Now how do we do this? I'll take first project 1 here. Net cash flow, discount rate, discounted net cash flow. Now here 0, 1, 2, 3. Here 0 it is 2 lakh negative, always 1. Today's rupee is equal to 1 always, and discount rate is 10%. Now year 1 I received 1 lakh. Year 2 I received 2 lakhs net, and year 3 I received 2 lakhs net. Now the discount rates I should identify 1 divided by 1 plus 10% to the power of 1. First year it is 9091. Second year it is 0.8264. A rupee received after 1 year equal to 90 paise today. A rupee received after 2 years equal to 82 paise today if it is discounted at 10%. If it is discounted at 10%. And 0.7513. So discount rate, how do I multiply this? 1 lakh into 0.9091 is 90910. 2 lakhs into 0.8264, 165280, and 2 lakhs into 0.7513 is 150260. And cumulative discounted net cash flow. Here I can ignore because this is outflow. So 90910 plus 165280, 256190 plus 150260, 406450. Nothing but the total of the three. Now I prepared this statement. I said 1 lakh received after 1 year equals to 90,000 today. 2 lakhs received after 2 years equals to 165,280 today. And 2 lakhs received at the end of third year equal to 150260 today. Now I should know what is my discounted payback. What is my discounted payback? So now I should know what is my discounted payback. Same formula like payback uneven, because anyway it is uneven. Once you discount it, it can't be even cash flow. Now what is the formula here? Discounted payback period equals to base year plus original investment minus cumulative discounted net cash flow base year divided by discounted net cash flow subsequent year. Now here the base year is, so the formula is almost similar to payback. However, here what is base year? Base year, you are collecting the entire money in second year. It is between 1 and 2. So your base year is 1. Your subsequent year is 2. So how do you do this? 1 plus Original investment 2 lakhs minus cumulative discounted net cash flow is 90910 by subsequent year discounted cash flow is 165280. So 1 plus 109090 by 165280, which is 1.66 years. 1.66 years for project 1. We can say project 1. Now project 2 we compute what is project 2 so that we can see what is the best project. So for project 2, same, what we should take? Year, net cash flow, discount rate, discounted net cash flow, cumulative discounted net cash flow. Discounted net cash flow, cumulative discounted net cash flow. So 0, 1, 2, 3, 2 lakhs, discount 1, 2 lakhs. So we will close this outflow. Now inflow first year is 150, second year 150, third year 2 lakhs. Yes. Right, 150, 150 and 2 lakhs. Discount rate 0.9091, 0.8264, 0.7513. So 1,50,000 into 0.9091, 136,365. 1,50,000 into 0.8264, 123,960 plus 136,365 is 260,325, and 2 lakhs into 0.7513, 150,260 plus 260,325 is 410,585 is the total. Now again, year 1 is the base year because you collected the entire money in year 2. So year 1 is the base year, year 2 is the subsequent year. We'll see the formula. Base year plus initial investment minus cumulative cash inflow of year 1, base year, by cash inflow of discounted cash inflow of subsequent year, that is 63,635 by 123,960 is 1.51 years. So if you compare both discounted payback period, project 1 is 1.66 years, project 2 is 1.51 years, hence we go with project 2, which is giving a earlier discounted payback period. So what we did here, we added discount rate and we discounted the cash flow and we cumulated the discounted cash flow, and the formula is as simple as the payback period, which is base year plus original investment minus cumulative discounted cash inflow of base year divided by discounted cash inflow of subsequent year. And the decision taken is shorter payback, select, higher payback, reject, because these are mutually exclusive projects. Either only one project you can select. So in this case, you selected project number 2 because project number 2 is giving early payback. Now with the same question, we can learn everything and anything in the same question, how it is. Now, if you see, the second important thing is NPV. NPV called as net present value method. What is NPV? Simple. It is present value of discounted cash inflows minus present value of discounted cash outflows. And it should be positive. If it is positive, decision is select the project with higher positive NPV. Higher positive NPV. In the previous question, if you take project 1 and project 2, outflow are same, 2 lakhs, whereas discounted cash inflows, or we can call them as present value of inflows. Present value means discounted. So present value of inflows, project 1 is total into 406450, project 1, and project 2 is totaling to 410585. So these are the discounted cash inflows of project 1 and discounted cash inflows of project 2. Hence your NPV here positive 206450. Here it is positive 210585. How you got it? 406450 minus 2 lakhs, 410585 minus 2 lakhs. So project 1 is having a positive, project 2 is also having a positive. Now, since they are mutually exclusive, select P2 with higher positive NPV. If they are not mutually exclusive, select both, because both are positive. Both are a positive. So selection is based on the kind of project, whether they are mutually exclusive or not mutually exclusive. Mutually exclusive, select the one with higher NPV. Now we'll do one only single question with NPV. How we can do NPV? Let us see. I'm leaving P1, P2, P3. This is NPV question. NPV question. Now, I'll say original investment is always year beginning. Call it as year 0. We call it as year 0, means beginning of the year. So all projects requires outflow of 1 lakh. Now, life, 5 years, 5 years. Now, inflows. I'm giving net cash inflows. Net cash inflows. End of year 1, end of year 2, end of year 3, end of year 4, and end of year 5. 20, 10, 5, 10, 20, 30, 20, 10, 15, 15, 25, 10, and 40, 30, 50. So I've given the data. There are 3 projects, P1, P2, P3. All the projects require initial investment of 1 lakh and the life is 5 years, right? And we are asked to compute what? You're asked to compute NPV. I'll say compute NPV discount rate 10%. Sometimes also call it as cost of capital. Means that is the minimum return you're expecting on the project. Right now, how do we do this? This we can do in a format wherein year 0, 1, 2, 3, 4, 5, discount rate P1, P1 again we need, I'm doing everything at one place, year, then discount rate P1, P2, P3. What I'll do here, P1 in between, cash flow, net cash flow, discounted net cash flow, net cash flow, discounted net cash flow, net cash flow, discounted net cash flow. At one place, all. At one place, all. So always for year 0 rate is 1. So it is 10%, right? As I told you. So 0 0.9091, 0 0.8264, 0 0.7513, 0 0.6, 1 divided by 1.1 to the power of 1, 2, 3, 4, 6, 8, 3, 0 and 5, 0 0.6209. Discount rates are given. Cash flows first we'll write. It is 20, 10, 20, 15, 40. P1 is, number 1 is 1 lakh outflow. Same outflow. Let me adjust this instead of writing at one place. P2, P3, cash flow, discounted net cash flow, net cash flow, discounted net cash flow. Yeah. So 20, 10, 20, 15, 40. So 20, 10, 20, 15, 40. 10, 20, 10, 25, 30. 10, 20, 10, 25 and 30. And last one is same 1 lakh outflow and 1 lakh. So what I am doing here, I'm just closing the top sheet because this is outflow. So this is 5, 30, 15, 10, 50. 5, 30, 15, 10 and 50. So we have taken the numbers from the question. Now what we should simply do is put the discounted values here. This into this. 20,000 into 0.9091, 18182, 8264, 20,000 into 0.7513, 15026, 15,000 into 0.6830, 10245, and 40,000 into 0.6209 is 24386. This is the total discounted. Now here 10,000 into 9091, 20,000 into 0.8264, 16, 528, 7513, 25,000 into 0.683, 17075, and 30,000 into 0.6209, 18,627. This is the total value of discounted inflows. And coming to last project, 5,000 into 0.9091, 4545, 30,000 into 0.8264, 24792, and 15,000 into 0.7513, 11,270, and 10,000 into 0.6830, 6830, and 50,000 into 0.6209 is 31045. So this is the third project. So what I did is I used the base as the same instead of doing it for every separately. Year 1, project 1 multiply, project 2 multiply, and project 3 also from 5,000. From here you're multiplying with this. So now we did for all project, we identified the discounted values. Now let me see the formula. Present value of inflows and present value of outflows. Outflow is same. Here outflow is how much? 1 lakh. Here also 1 lakh. Here also 1 lakh. Now inflow I need to compute. What is the inflow of first one? 18182 plus 8264 plus 15026 plus 10245 plus 24386. Total is 18182 plus 8264 plus 15026 plus 10245 plus 24386, 76,103. So net present value here is negative 23,897. So this project is not of any value because its net present value is negative, though it is generating 30, 20 plus 10, 30 plus 20, 50, 50 plus 15, 65 plus 40, 105 absolute numbers, but the present value discounted at various years is coming to 73,103. Go to the next project. It is 9091 plus 16528 plus 7513 plus 17075 plus 18627. That is giving you 68,834. This is also giving you negative NPV of 31,166. So this is also not a good project. Now coming to the last one, 4545 plus 24792 plus 11270 plus 6830 plus 31045, 78,482, leaving you a negative NPV of 21,518 negative. So all the three projects you reject. Why? Because the NPV is negative. So we need to make sure that the NPV is positive. Now suppose say if initial investment is 75,000 for all projects, no other amounts changed, only initial investment changed, then how do we compute present value of inflows? 76,103, 68,834, 78,482, and present value of outflows 75,000, 75,000, 75,000. Then NPV, here positive 1103, here negative 6166, here positive 3482. Now this is straight away cancelled, and out of 1 and 2 you select 2 if it is mutually exclusive. If it is mutually exclusive, these two reject and select this. If not mutually exclusive, select this, reject this, select this. You can select both because both are giving you a positive NPV. Basically NPV means net present value, and the net present value means what? Net present value means the present value of inflow should be more than the present value of outflows. If that is positive and mutually exclusive, select the one with higher positive NPV. If that is negative, don't select it. If they are not mutually exclusive, select all projects with positive NPV. So NPV and discounted payback are not two different things, which are almost using the same table, same calculation, right? With this, I think we'll stop it here today. We'll meet again in understanding present profitability index, IRR, adjusted NPV, and MIRR in the coming sessions. Thank you.